This is Trading 101. I'm just trying this out now and seeing if it's going to be any use. What I'm going to be talking about here is mainly the how to read and interpret candlesticks, how to know how to use TradingView, and how to choose your broker and all the orders related with that. This is just a really basic guide right now just to start this off, just to see on where it goes. You can skip to the next one if you already know this, and there's no script with this. So, how to interpret a candle. Most default on TradingView or on anything, on any type of brokerage, there is whenever a candle closes above its open price, it's going to show green, or whenever the current price, because the close price, the top part of the body, is higher than the open price, is going to show green, and if it's going below, it's going to show red. And whenever the say the opening price, say this is $100, say if it starts to drop a bit, where then it goes to like $99.5, but then it gets bought back up at that point, is going to make what's called a wick, or some would call it a lower shadow. It's mostly going to be referred as a wick. I will be referring to it as a wick. Now when price gets to these areas, we'll learn in price action, price is likely to be bought up again. But it depends on what type of candle you're looking at. And then say if it keeps on pumping upwards, and then it gets to a certain point, say 105, and then a small sell-off starts to happen where it brings it back down, it'll then make something called a top wick, where that top part will be its highest price. And once the candle closes, a candle close would be when the full movement of that candle is done, where it sets its open price, its close price, its highest price, and its lower price. And it's the same, just in reverse, for a sell candle. Whenever price got below its open price, so instead of the opening price being at the bottom, its opening price would be at the top. And the higher and lower are still in the same area. But whenever price would start going above its open price, it would show green. But whenever price is going below, it would show red. And it'll go, and once it closes, it'll complete the full candle, and the candle will close. And you'll see that its closing price would have been below its opening, which would make it now a red candle, a selling candle. These can also be interpreted as a bullish candle, where the price closed above the open, and a bearish candle where price closed below its opening price. So then you would mostly be looking at a lot of your charts on TradingView, and it gets kind of complicated at first, but it's really easy to understand after just looking at a couple areas. So I'll switch over to it. So this is TradingView. Now it looks like a lot because there is a lot going on in here, but we can just break it down pretty simply on what is happening. So the first thing first would be this top area is where you should have your first attention to, where you will have your ticker symbol right here, or your stock symbol, which is something you can also click on, and then you can search in other companies like that. Or a lot of times you don't even have to click over there. If you're just selected on this normally, you can just start typing. And then over on this part, you can do change interval, which then you can do day, D for day, M for month, W for week, or then you can do numbers like 15 minute or 1 minute, 10 minutes. These will be very important for the price action area. And this also works the same way, where you can just click one anywhere on the thing. And these top areas over here, where the O shows for the opening candle, since my cursor is not anywhere, it's showing you the most recent. So since we're on the 1D, so the 1 day time frame, so if you're not selected on anything, it'll show you the opening price, which is shown by the O, which was 187.48 at this time for Nvidia, the high, the H, the 187.5, the low, L, for 181.59, and then the closing price 182.8. And it also highlights it red because the closing price is below the opening price, as you can also see over here. And you can adjust it by this side part. You can adjust it up and down to make it just more easily viewable. A lot of times you don't really want something like this because it gets really difficult to read and it's kind of just messy. So it's always nice to keep this just nice and like small amount. If I would recommend that if you're on the 1 day interval, you would have something where you would see pretty much every line be equal to $1 and change. And you would use your scroll wheel, your mouse scroll wheel, to change on how wide it is to zoom in and out. And then you could also use your scroll wheel on this to shorten it, but it's just easier to drag. If you don't have a scroll wheel, this also works with shortening, with just holding the bottom part. But you can see here on how it's opening its opening price opened at this point, which was 187.48, which its price you can see over on the side here. And you can see price started to drop all the way down to 181.6 essentially, and then got bought back up all the way back up to 182. And you can see this with every single candle. And you can see on this previous green candle, where now since we're highlighted on this, you can see at that top area it has changed to now represent this candle. So on this candle, the opening price was 184.26. It did drop down at some point to 183.95, where then it shot all the way back, up, going as high as 193. But at that point, it went down. It went and closed at just above 190. You could also switch it to this side part here, where it's going to show you its ticker's name, its the company's name, what industry they're in, and what exactly they provide. So with Nvidia, they're in the electronic technology, and they provide semiconductors. This will be different for different companies, and you can see the most latest news on them. Like Nvidia faces competition from AI chip startups, like different companies, which these things are pretty they're pretty good for understanding on any of the most recent news that could be causing certain things to be happening with the chart. It also gives you key stats on the side, where its next earnings report is going to be in 11 days, which you could also see on the chart itself. And it will give you the period ending. So January this year is pretty much where it stopped taking any more reports. Say if some new tariff just came out, it wouldn't affect their earnings if it just came out in February, because their earnings has it ending in January, and it gives you their estimate and their earnings estimate and their revenue estimate. market normally looks at revenue for most companies and not too much on earnings. So that is more of a thing to look at. And you can see from its previous earnings, and it shows you what point. It'll also show you a night thing for after market close, so it will be giving its earnings after market. So this candle could not be fully representing on what the actual earnings is actually going to do. It will be the next candle after, since it's after market close. Next market open, we would have priced it in fully. So you can see as it started rising, it didn't have too much, but then you have this huge move. So from this close before, a 186 close, market closed there, but then gapped up, went all the way up to 196 from that point, where then price then fell further. So that's what's really risky about earnings, is that you don't know if price is going to gap down or if it's going to gap up. And then it's another thing entirely if price is even going to stay there. Could it keep on rising after that, or could it keep on dumping after that? Going to the side, you get the average volume of the last 30 days, which if you see the volume of today, which is being 161 million, which can also be seen on this side part here, and with all these bars, that's what they represent as volume. Whenever it's red, that means the price closed lower, so most of this volume, or say most since price closed red on Friday at 161 million, majority of this 161 million was selling, which caused price to close red and below and be bearish. But since the average volume in the past 30 days is 171, the volume, you could argue that this is getting a tiny bit into price action. Since volume was less than average and it went down, if market gets back into normal volume, price could reverse and start going back up. That's one way to look at it. And then you get the market cap of it, which tells you on how much money is invested into this company. And this is where you can have blue chips, well-known companies that are normally in the 100 billion to the 1 trillion mark. You can get the high value stocks, which are in the 1 to 10 billion range. You get the mid caps, which are in the 100 million to 500 million dollar range, and then you get the small caps, which are in the below 100 million range, which pretty much means less than $100 million is invested into the company. And then this is also one thing that gets majorly overlooked, is the share float. This is pretty much essentially how many shares are available to buy, how many shares are available to purchase. And with these two items, the market cap and share float, you can essentially calculate the supply, the share float, and the demand, the market cap, to find out where price should be. Last I calculated it, Nvidia came out to be 184. So you can expect that 184 would be a decent area to buy it. That would be essentially fair value, based on how many shares are available for purchase and how many people have put money in there. How many people want this type of company? Whenever selling happens, the amount of shares in float go up and the market cap goes down. Whenever people start buying, shares go down, market cap goes up. Pretty simple. And you can have the historical earnings report and see on how much they beat and if they are actually growing. You could also see on how much they make and how much they give in dividends. So their last payment was 0.01 cent per share. So that pretty much means if you have one share, you get a cent in dividends. If you have 100 shares, you get $1 in dividends. And for Nvidia, that's it's not that great, but people choose it because it's deemed a high growth stock, which means its earnings start rapidly get higher estimates and it keeps on beating, and its price keeps on increasing and increasing. And then you also get their income statement, which you can also go from balance sheet to cash flow, but it's best to just keep it on income statement, where you can get its quarterly, where you get its net margin, net income, and revenue, and you can compare on how much. You can see if their net income could be actually dwindling over time, but their as the revenue is getting higher, or if their revenue is getting higher and their net income is staying the same. You could even go to the annually and see at what point they started actually taking off from it, and then you could even go to news or find their earnings on when that would actually come out. You can find their performance, like their stock performance, based on the 1 week. So in 1 week, how much did they gain? In this case, it gained 3.46%. On 1 month, they're pretty much at break even. On the 3 months, they are at break even. So it's pretty much saying it has not changed in 3 months, and has only lost almost a percent in 1 month, but has gained 3% in 1 week. And you have different seasonals. Sometimes certain companies can follow these charts. Whenever you can see during February of 2024 and 25, it started to dip a tiny bit. So if this stock seems to do that consistently, you can make a bet that it would start dropping into late February. But since in this stock, and compared to 2025 and 24, it seems to be way more volatile in 24, so it's unlikely that this company could be following seasonal stuff. And in here, I mostly ignore a lot of this because it's a lagging indicator is what it's called. So it waits for stuff to already happen and then it updates, so which means you could be very late and get easily manipulated. So one area you can look at is a 1-year price target, where a lot of people could be looking to sell a lot of their shares, and a sell-off could happen. So Nvidia's 1-year price target is 260. So when price reaches 260 all the way up here, you can expect a bit of a sell-off after that. And you have its full profile where it links their website and a description on what exactly they do. And then if you go into a lower time frame, where if you do 4H to get to the 4 hour, it is essentially the same as daily. On here, it doesn't look like much. It's going to get a bit complicated, but at the bottom point, at the bottom right area of where you can see time zones, where you could have UTC or the exchange of the time zone, or wherever you are, it's best to have it on the exchange time zone, because most of these are NASDAQ or NYSE, which is the Eastern Standard Time. You have this area, regular trading hours. So when you click this, you can change your sessions. You get to see the extended trading hours. Now, if we're gonna have to zoom in a bit for this, you can see on what on essentially, let's go back to that earnings from beforehand. You had price that opened over on this point here at 185 and then closed over here. When the earnings finally came out, price didn't just naturally just gap all the way up here. It was in these extended trading hours where it started to rise upwards, and then where it finally capped out at 196 where it opened, because there was a huge wick here, closed below there. It wicked again from its open, but then closed below and then tried wicking again. So really it capped out at 196.85, where then if we go to a lower time frame again, the 1 hour, and go back to here, it's a bit easier to see, because now you can see at the bottom where it shows like 18, 17. So it shows you on when exactly these candle closes happen. So you can see at 9 o'clock, so market opens at 9:30. So market opens somewhere in between this candle. You can see that price came all the way up and then consolidated, where price moves sideways at 196 for a while until market opened, where then it finally started to drop until 10 o'clock before all the consolidation was done, and then finally went bearish and started dropping all the way down. So price doesn't just magically go from 186 and then gap all the way up from here. It's actually moving in after hours or after market, pre-market, post-market. These are all terms for it, and is really good for finding what exactly price is trying to do at certain levels, because on a 1 day time frame you don't get these extended trading hours, so you get to see on where exactly price wants to go. And because say on this part here it had a high of 210, you would have never known that the next time it peaked again, it actually went all the way up to almost 200 in aftermarket, because on a daily it closed at 198 and then actually opened at 195, but really it hit 200 in aftermarket trading. So then after that, you can then also go to this top area, which allows you to switch to different time frames, which we've already kind of gone over. And over here you can switch it from the what type of chart you want. So there's the candles, hollow candles, which it makes the buy candles hollow. There's no reason you should really change these. Just normal candles would be fine. What you would normally see on a normal stock is just by looking at the line, which is taking the closing price of each candle and charting that down as a line, or it's maybe something like this, but you're always going to be sticking with just candles. So then you can go on to indicators, where then you can find a whole lot of different indicators that we will get into, where like there's technical ones made by TradingView itself. If you've made any scripts, you would see it here. Or any fundamentals you could also put up on there. There's whole strategies that could be made, different types of patterns, which I think you might need to pay for. Like one main indicator you will see is an MA, a moving average. You could have exponential moving averages, but we'll get into a lot of that in the next one. That is just where you will find it. But that pretty much for now concludes what you're like on a daily basis, what you're going to be using on TradingView. So we can go back to the other point to get into brokers. Here are the different type of brokers, the three main ones, at least in Canada. We got Wealthsimple, and we got Webull and MooMoo, and they all have their uses, and it for which broker you should choose really depends on what you are going to be doing, and they all have very different commission levels and their pros and cons. First, we have Wealthsimple, which is just the well-rounded brokerage to use. I listed their commission fees in their starting plan, their core. If you just have $1 with them, you pay $0 in commissions. You can deposit up to $50,000 into their checking account, and you pay $0 on options. And after that, pretty much everything's the same except for the margin interest rate, which I won't get into. And then if you have 100,000, you get I'm pretty sure the USD transaction fee waived, because you just get a free USD account and start just investing as if it was a USD account. So this is really great for just if you want to buy shares and not worry about any major fees. It only has the normal SEC fees or any other type of filings that is required for these brokerages to have, which most of the time you won't even notice. The main con with them is that it is, in its name, a very simple brokerage. So all you're going to be given is a line graph that shows the current price and the closing price, and it does have a 15-minute delay on it, but it is very easy to understand when looking at it. This is on its mobile. Its web page is a bit different, and you can just use around with it. I'll get into option spreads probably way later, and I'll show it on different brokerages on what they look like. But this they actually recently changed their charting thing to now show candlesticks, at least on the on your browser, and you could also add indicators to it, which is nice. This I would actually recommend for if you're starting out, like actually getting into trading, because they don't have a paper trade account like a lot of the other like the other brokerages listed on here. But just the $0 commissions on a lot of this keeps your trading cost very low. The next area is Webull. Webull is really good if you're a big trader. Its brokerage is a bit more harder to understand. This was taken from their desktop app, which they have, and it has a lot of it going on here. It has a trading view style type of chart in the middle, where it also has your order entries at the bottom and where you can place your trades over here. So it's essentially bringing the trades, the trading part into trading view, so you can do like live account. It also has the paper trade, which this is actually on. That's what it says simulated by option and data. While this one is actually very quick. It's pretty much every tick, which is pretty much every price movement it updates, which is really good. I like Webull for that reason. For their US stocks and ETFs, because that's what we're mostly going to be touching, is their trading fee is around $3 per trade. So that includes for buying and selling stocks. So one whole transaction would cost you normally around $6, which is on the pretty high spectrum. I wouldn't use Webull for stocks or anything. I use them mostly for options, because they have that really quick time, which on their trading fee is 99 cents per contract. So normally you're going to pay like $1 to $1.02 for every one contract, which is pretty good considering on all the stuff they have, especially with the very quick data. And it's just all the normal fees, and that's pretty much all the fees that they take. They won't take anything else for having your account with them. Next one is MooMoo. Now, I don't use MooMoo, or I don't fully like them. It's kind of like a jack of all, master of none, and it is kind of difficult to understand on how much they actually charge per. They have so even though it does say like it's like just under 1 cent per share, the minimum per trade is $2. So on average, you're like not average, like per transaction, you're gonna be paying $4 per. So not that great again for stocks. Better than banks. All of these are going to be 10 times better than banks, and it's going to cost you around $1 per contract, or per order. Its mobile app is, I would say, pretty complicated for beginners because there's just a lot going on the screen, and it's not that user friendly, but it does give you ready like analysis, the option spread, or a lot of the news. It gives you a lot of the sentiment graphs. What is the fear and greed index? Like, it gives you a lot of information, so it's a good one stop for everything. It's just really great for all these things. But I've not traded with them, so I don't know on how great it is with that. I just much prefer Wealthsimple and Webull. Alright, so now it's on to the different types of orders. These are going to be your pretty much on how you put in any of these orders into the market. So you have your market orders. So say if SPY, and tickers are normally going to be written with a $ in front of it. So say if SPY, a derivative of the S&P, is at $690, when you place a market order for it, it's going to buy at $690. It's just going to buy immediately, and guaranteed it is going to is going to complete that order. Now, and it's the same thing that goes with sell orders. So say if you do a market order on a sell, and you want to sell SPY at a profit of $695, and you place the market order, it will fill exactly at $695. But that is only if, in both of these situations, that is only if the actual market, the actual price of SPY, is $695. So say if you want to set a future price on it, and SPY currently is at 690, and it drops below and to 670, and you set up a limit order to buy at 670 even though price is at 690. So it will not fill at 690. Say price keeps on falling and falling, and then eventually reaches 670. It will then fill that order at 670. You will then buy the stock at that point. Say now after you buy SPY at 670, it rises all the way back up to 690, and you thought that was going to happen, so you put a limit order to sell at 690 even though price is at 670. When it starts to rise back up, it goes to 670, it automatically sells, assuming you put the proper cancellation. If you put it to a GTC, which is good till cancel, these expiries will mostly be seen as GTC, which means good till cancel. So it pretty much means this limit order will not cancel, and it will not expire until you actually cancel it yourself. Now with some brokers, none of the ones listed have any higher fees, like extra fees related to for a good till cancel. But most of these will have a GTE, so a good till expiry. So it could expire at the end of the week. You can set it to expire at the end of the week, at the end of the month, or in like 14 days. It really just is up to you. And that is limit orders with a buy limit and a sell limit. Now, this area is where it gets kind of interesting, and a lot can be done with these. So, a stop order, there is two types of stop orders. There's a stop market order and a stop limit order. So there is stop market orders and stop limit orders. Stop market orders, this is the main point. These stops are looking like how it is over here, is waiting for price to start moving, and then say if SPY is at 690, and say if there's like a trend or something and you're unsure if it's going to keep on going up, you can put a stop a stop market order at 685, where then once price crosses 685, it'll then open a market order and then buy it at 685. This is really good. This is called a sell stop. You can use it as a sell stop or a buy stop. This is really good for having as stop losses. So say if you're in a long at 690, and if price goes to 685, you don't want to take any more losses, or it's essentially with your technical analysis is going to go down further. You can then put a stop market order at 685, and what this will essentially do will just wait for price to come to 685 area, and then it'll make the actual order on it. Because that is another thing. If you have these limit orders, it's essentially, say if you have 10 shares that you bought, when you create a limit order, it's saying these 10 shares are going to be they're going to be sold at that price. So now these are no longer in your account, pretty much. It's not recognized. So if you try doing anything with these $10, like say if you try selling it at market, it won't work, because these are essentially waiting for a buyer at whatever your limit price is. While a stop order is just waiting for price to come down to 685, and then it'll make that order. So you could also have it as a if you're in a short position, you could have it as a buy stop to pretty much have it as a take profit. So say if you're in a short position and you believe the stock is going to go down and it's at 690, when it goes all the way down to 685 and that's your target price, it'll then create a market buy order. Since you're shorting the stock, you're essentially having it in a sold position. You get more on that later, or you would pretty much sell your short at that price. Now what a limit order does, you could do it in a very interesting way, where you can almost make an entire strategy from it. Say if SPY is at 690 and you believe it's going to drop all the way to 685. Say if this is like below a trend, now it's below this point, you want to set a limit order to buy at 689 or something, because now it's back into your area. This will now, when price reaches there, it'll set aside a bit of your money for it, and will now put a buy order for 689. So since it's reached there, it will wait for price to come back up, goes to 689, and then it'll place your buy order. and it works the same way for selling. Say if SPY is at 690, it goes up to 695. You can then essentially put a trailing stop to where now you have your sell limit, your limit order, to break even to now 690. So now you pretty much let your shares run, and if it ever dips back down, you just get out at break even, and you've lost essentially nothing. So it's a really stop orders have a lot of purpose. And I was just trying this out now, so I don't know if there's anything that I missed. This is probably a longer version, just getting everything, all the basics out of the way, so then we can go talk about patterns, trends, and price actions. Just a lot of the good stuff, pretty much essentially everything that I look for in a chart.